Hi there again, and welcome back to our grade 12 Maths Lead Cap series. I'd like to thank you for tuning in, and I hope this video will be of great benefit to you. Now, in the previous video, we discussed water tariffs, specifically looking at how you actually calculate the total cost and how you actually use the water tariff table and all the calculations that you carry out. So if you haven't checked that video out, guys, it should be in the description box and it should appear on the top and right of this video. Right, so in this video, we will be going through income, expenditure, profit, loss, break even. Okay, so there's many terms that we are going to discuss. I'll break this up into two parts. The second part, we will be looking at how you actually draw the graphs of income, the graphs of expenses, how you identify the break even point, okay, and so on and so on. Okay, let's start with the terminology then, and then we'll actually perform calculations on one of the activities that I have gathered. So let's start with the term income. So income is simply, guys, as you might have expected, income, this is an amount of money that is received, okay? And we usually say income when we are actually referring to money received on a regular basis, but it really doesn't have to be received on a regular basis as long as money is received. Now, the frequency in which you receive this money is very important, and we actually categorize different types of incomes based on the frequency. In other words, how often do you receive this money? If, for an example, you are an employee and you actually earn a salary, so you have a job, you get paid the same amount of money every time the month ends. So that is what we call a salary. Okay. And by the way, guys, there's a difference between a salary and a wage. Okay. So when it comes to a wage, you get paid weekly, but you get paid according to the hours that you've put in. Okay. But when it comes to salary, this is constant. Okay. So you get paid the number of days in which you worked does not really matter. Okay, so when it comes to a salary, guys, it's at the end of the month. Okay, so this is month end, and it is irrespective of the amount of hours that you have put in during that month. Okay, so that is a salary. And then when it comes to a wage, you get paid each end, okay, every week. So at the end of the week, okay, and this amount of money you receive is dependent, okay, so it can fluctuate. It's really dependent on your working hours. How much have you worked? How many hours have you put in working? Okay, so this, I would say, is not fixed, but it's not constant, but rather it fluctuates. Or let me rather use the term variable. Okay, so variable means that it is not constant, it keeps on changing, okay, depending on multiple factors. Okay, so in this case, this depends solely on the number of hours that you have worked during that particular week. Okay, so know the difference between the salary and a wage. Okay, so now when it comes to fixed income, guys, okay, so as I was saying, you are an employee and you get paid an amount of salary each and every month. Okay, so let's say it's 5,000. So each and every month you are going to get paid the same 5,000. Okay, so that is your income. Okay, and because this 5,000 rands is constant, okay, it's fixed, right? So it's the same amount of money that you will receive each and every month for that whole particular year, okay, unless there are changes that are made. Okay, so in this case, this type of income, we call it the fixed income. Okay, so fixed income, this is simply a constant income of the same rand value per month. Okay, so each and every month you get paid the same amount of money. So this could be this is so on a personal level. Okay, like as an employee, you get paid a salary, right? But as a business, just think of a business now. Let's say you are an owner or you are the employer in this particular company. So your income really comes from sales. Let's say it sells. Let's say you guys are selling a product, right? And so that your income, when it comes to your income, this fixed income, we would call it, of course, the sales. Okay, so it could be a contract. Okay, so when you have agreed, let's say you are a farmer, let's say you actually produce apples. Okay, so you produce apples as a farmer. Okay, and you make a deal, okay, with one of the supermarkets. Okay, so you make a deal with them that you will actually provide them with 4,000 apples during the harvest time. Okay, and this could, let's say, go on for like 3 months. Okay, let's say for 3 months, you will provide them with apples, 4,000 apples, and they will give you a certain amount of money, right? So this is a contract and it's constant, right? So each and every month they will provide you with the same amount of money, and that money is constant. Okay, so that's why we are saying that, okay, when it comes to businesses, okay, there are contracts that are signed, and the business receives the same amount of money each and every month. Okay, so it really matters at which level are we referring to. Are we talking about the personal level that speaks to the employee being paid each and every month or each and every week, depending on that? Or are we actually referring to a business level where now there's a contract, there's a constant income that they receive, okay, which we call fixed? And then the variable income, that is changing income. So as I said, variable, guys, really refers to fluctuating. Okay, can go up, can go down the next month, so on and so on. So it really depends on factors. So in this case, variable income. So it's a changing income of a different rent value per month. Okay, so maybe this month you might make 10,000. The next month, your income that you will receive is 7,000. Okay, so it's really dependent on many factors. Let's say you own, you have a stall where you sell food. Okay, so you sell fat cooks, and each and every time, each and every month, you actually count your money. Okay, so if you are going to sell fat cooks each and every month, you will probably not get the same amount of income each and every month. Okay, maybe during January you actually will make, let's say, 2,500, and then the next month, say the next month, that's Feb. So in Feb you actually make a bigger amount. Let's say you make 3,000, right? And then the next month, okay, which is March, you make a smaller amount, which is 2,700. So as you can see, the amount of income that you receive each and every month is not the same. It really is dependent on the number of fat goods or products that you have sold. Okay, so that is your variable income. Okay, it will keep on changing month after month. Okay, and then let's say if we are talking on a personal level, let's say that you get paid commission. Okay, so commission is simply an amount of, or a fraction that you get paid, that comes from a sale of a product. Okay, so there's been many of these companies that pay people commission nowadays, like your Herbalife, so on and so on. So you work for them, and when you actually get someone, or you convince someone to buy a particular product, they will give you a percentage of that income they receive. Okay, so let's say you were able to convince someone to buy, let's say, those particular products, let's say three products, and these cost 3,000. And so the company will say, okay, we'll give you a commission of 5%. Okay, that means that for every 3,000 that you will receive, the company will give you 5% of the 3,000. Okay, so now month after month, you're not going to convince the same amount of people. and they are not going to buy the same products. Okay, there are many different products. This particular person will buy a particular product, and so you will make 5% of that amount of money. Maybe they are buying a product that is worth 5,000 rands. Okay, this month you get the same 5%. So as you can see, that is variable income, guys. 5% of 3,000 is not the same as 5% of 5,000. Okay, so as you can see, that is variable. Okay, it really differs. Okay, depending again on the number of products that were sold. Let's say you are employed at a particular company and you get paid a constant salary. So let's say that constant salary they pay you is 5,000 rands. Okay. So in this salary, if the company pays you this salary, what type of income would this qualify as? This would qualify as fixed income. So this is a fixed income, guys, right? So you keep on getting the same amount of money each and every month, right? But you also have a side gig. Okay, so on the side, you actually wash people's cars. Okay, so let's say you have a car wash, right? So people come with their cars, okay, and you wash them, okay, or you have someone else washing those cars for you, okay, right? So let's say each car now you wash each car. So each car you wash it for 75 rands, okay. So that's 75 rands for each car, okay. So of course the number of cars that you're going to wash each and every day will not be the same. Okay, so it will change, it will keep on changing. Okay, so that means the amount of money that you will get will depend on the number of cars that you have washed, right? And so, what do we call that type of income? Okay, that is dependent on the product sold or the services rendered. So, that we call the variable income. So, in other words, we're saying that the car wash provides you with a variable income, and then your job, okay, your 9 to 5 provides you with a fixed income. Okay, so this you will get each and every month. That really does is not dependent on the number of hours that you've worked. You will receive the same amount of money each at the end of each and every month. Okay, now, well, this one is will depend. Okay, so it depends on the number of cars that you have washed. So let's say I have washed 2 cars. Okay, so if I have washed 2 cars in that particular month, then when I count my variable income for that month, I'm going to say 75 rands times by 2. That will give me a 150, right? So this 150 is the variable income that I have made, right? So this means that, okay, I can actually create my own formula, my own equation, okay, and that will enable me to calculate the amount of income that I will receive. So, and that formula will be, okay, so I will take the unit selling price, okay. This is by what I mean by unit selling price, I mean that the selling price of one product. Okay, so in this case, your products are your cars. So, how many cars? Okay, so a price for one car to wash one car is this much. Okay, so you always have to ensure that you take the price to buy or offer a service of one unit. Okay, in this case, it's one car, and that is 75 rands. So take that 75 rands and you multiply by n. Okay, so it will be 75n. So that n refers to the number of cars that I have washed in that particular month. So I use this. This is the formula that I use to calculate my variable income, right? So that is the formula that I will use there to calculate my variable income, and this again will differ, guys. Okay, depends on the number of cars you've washed. If I've washed 4 cars, then I would say 75. Use my formula and substitute in there 4. Okay, so it will be 75 times 4. Okay, it will give me a different income that particular month. If in that particular month I've washed 10, then you put in 10 there, and then you get your variable income. So now To make things simple now, like to consolidate everything, when you want to calculate the total cost now, the total income, I mean, the total, when you want to calculate the total income, you will definitely want to add the fixed income you receive from your work and also the variable income that, of course, depends on the number of services rendered. Okay, in this case. Right, so then that means that my total income will be fixed income plus variable income. Okay, so that means that I will say total income, okay, is always going to be equal to the fixed income plus the variable income. Okay, so the fixed income, guys, as we said, okay, it stays the same. Okay, it's not dependent on anything. So the fixed income is 5,000 rands. Okay, so when I write down the equation for my total income now, I will write fixed income, which is my 5,000 rands, plus the variable income again. That you write down that equation. That's 75 times n. Okay, so this then gives you the formula that you will use to calculate the total income that you have received during that particular month, right? Okay, so there we go, guys. Okay, it's not very difficult. You have to first be able to differentiate between fixed income and variable income. Once you have detected that in that question, then formulate a formula for the variable income and then write down this formula. Okay, that will give you your total income, right? So you use that in each question to get your total income, right? And then the third type of income is unforeseen income. So unforeseen income is like a once-off income, or it's an unreliable form of income per month. That means that you did not foresee it. You did not see it coming. Okay, so it could be pocket money. Okay, maybe you do not usually get pocket money. It could be like a gift, okay, from your parents for your birthday. Maybe they give you 500 rands for that for your birthday, or it could be a donation that is given to you. Okay, could be anything. So it really is that type of income that you do not expect to get. Okay, so for the fixed income, you definitely do expect an amount of money, a constant amount of income at the end of the month. For the variable, depends, but for the unforeseen, you do not really expect it. Okay, right. Okay, so let's move on. So that those are the types of income, guys, and you have to be able to master them. Okay, be able to detect them. Okay, and be able to differentiate between them. Okay, and the equation part is critical. Right. Okay, let's move on. So now we have an expense. Okay, so the expense term is really the amount of money spent, okay, or money that was used, right? We use money to buy like toiletries, so those are your living expenses. You use money for your, when it comes to the business, for the operational costs, okay. So it really is, of course, dependent on the frequency again here. For the expenses, we also have a fixed expense, a variable expense, and also an unforeseen expense. Okay, so I'm sure you probably do have an idea of what these are, of course. So a fixed expense, this is an expense that is the same each and every month. Okay, so working and you are renting. Okay, so your rent is going to be fixed, right? So the landlord will say, I want my 1,500 each and every month. Okay, that always will be the same amount of money. You always pay this 1,500 to your landlord. Okay, that is your rent, right? So this is, rent is a fixed expense, guys. Okay, and when it, so this is on a personal level. And so when it comes to a business, okay, so a business will pay, for an example, electricity, that will be the same throughout the month, okay. It could also be operational costs, okay, but operational costs might change here and there, okay. But for, let's say, the expenses, say you have the salaries, okay, so the salary that the company will pay out to employees will be the same throughout the year. Okay, so they will pay the same salary to the employees, and so this is on a business level, and the rent could also be on a business level because a lot of companies rent out the land that they operate on. Then a variable expense. This is an expense that changes every month. Okay, so it's not the same, keeps on changing, right? So a variable expense in this case on a business, on a personal level, could be your toiletries. Okay. So could be like your living expenses. Let's just say living expenses. So the clothes, food, those will not stay the same each and every month. Maybe you're not going to buy a lot of clothes this month, and you buy a lot of clothes next month, so on and so on. So the living expenses do change. Okay, they can be certain amount of money this month and a different amount of money next month. Okay, for a business on a business level, expenses could be the operational costs. Okay, because I am selling fat cooks, I am going to buy more flour this month and more cooking oil, okay, because maybe there's more demand, people are really buying this, and so the operational costs really depend, again guys, on the products or the goods, okay, that are sold or the services that are rendered. And then the unforeseen expense, that is an expense that is a once off or very unexpected. So it could be that maybe there's a ceremony that is happening and you did not plan for this, or maybe there was family member that passed away, and so now you have to reach out of your pocket and spend on travel. So you travel to that particular province, so it could be traveling costs. You did not really expect this expense. Okay. On a business level, this could be a strike. So a strike is a huge cost when it comes to your businesses. We see that in each and every year that there's strikes, especially in the mining industry, really does occur across different industries. A strike, you do not plan or expect a strike. It happens unexpectedly, okay, and that is a cost to you. So now let's talk about the equations and the calculations when it comes to these. So a fixed expense, let's say now for one car, now we have to think about the operational expenses. Okay, say this area in which you are watching these cars. Okay, this is this is someone's land and you are actually renting out that land. Okay, so think about that now. So you are renting out that land. Let's say you are renting um, 200. Okay, let's say the rent is 200 rands. Okay, so that means the fixed expense is rent and it's 200 rands. Okay, so this is rent. You're renting out the space on which you are washing these cars. Okay, so that is the fixed expense, 200. Okay, that will be the fixed expense. Now let's talk about the variable expense. What would be a variable expense in this car washing business of yours? So you are going to need soap, you are going to need sponges, you are going to need a polish. Okay, so let's say for one car, so you try to break that down and ask yourself, how much soap do I use? How much polish do I use? How much sponges? How many sponges do I use for one car? Okay, and so you add that up and you find out. Let's say it's 80 rands per car. Okay, so you actually spend 80 rands on soap. So this is soap, um, sponge, okay, and also the tire polish, okay, and also the water, okay, the water as well, water costs. Okay, the amount of water that you use. So let's actually up that, and let's say it's 100 rands. Okay, maybe 90 rands. Okay, this is the amount of money you use to wash one car. Okay, so this is a unit cost. Okay, so this is a variable then. Okay, because it will depend, of course, on how many cars do you wash um, at the end, how many cars you have washed at the end of the month. Okay, so for the variable expense, now when you want to now you want to create your own equation that will enable you to calculate the total expense, variable expense that you have incurred at the end of the month. So that will be, you'll take the unit cost, guys. So that means that the amount of money that it costs you to wash one car in this case. Okay, so that is 90 rands, and then you multiply that 90 rands by the number of cars, so that is n. Okay, so then that means that as you can see, the equation will be 90n. Okay, or like this, you can write it like this, 90n, right? So now you want to calculate the total expenses. Okay, so if you want to calculate the total expenses, you are going to have to add up again, guys. You have to add up the variable expense plus the fixed expense. Okay, expense, there we go. So now that is going to be 90n. Okay, so always start up with the variable expense equation. So it will be 90n plus the fixed expense, which is 200 rands. Okay, so this will be the total expense that you have incurred at the end of the month, and that will be the total income that you have received at the end of the month. Okay, so I hope this does make it easy for you. Let's then move on and see other terms. Okay, so now we have these two terms, which we call the profit and loss, right? So the goal of each and every business is to make profit, guys. Okay. And what is this profit? Well, profit, this is when the income that you receive is bigger than your expenditure or expenses. Okay. So when you have an income that is bigger than your expenses, then you have made a profit. Okay. So we also call it the surplus or disposable income. Okay, so on a personal level, we call it disposable income. So disposable income is simply is the amount of money left after you have subtracted all of your expenses, all of your living expenses. So on a personal level, you receive a particular income from your job, and then you subtract the expenses that you have, like your rent, water cost, electricity, clothing, food, groceries, so on and so on, petrol, everything. You subtract all of that, and whatever is left, we call it the disposable income. Okay, this is the money that you can spend on whatever that you want to spend. Okay, so it's disposable, right? But for the on a business level now, we do not call it disposable income. We rather call it the profit. Okay, so profit. So it's the same thing. You take the income, you subtract the expenses. Okay, so expenses, your operational expenses, you have to pay your labor, which is your salaries. You have to pay water, electricity, so on and so on. Okay, and then after that, after you subtracted those expenses, now you are left with the amount of money you are left with. We call it the profit. Okay. Now, what happens if your income is actually less than your expenses? Okay, so that we then call it the loss. So you've made a loss, and no one wants to make a loss, guys. So a loss is when your expenditure is bigger than your income. Okay, so you have more expenses than what you actually get. Okay, and so you've made a loss. Okay, now you are in debt because you cannot afford to you do not have enough money to cover those expenses. Okay, so you are in debt or you are in shortage. Shortage, we also call it the deficit. Okay, that is shortage. Okay, right. So that we call it the loss. Okay, you have made a loss. Okay, right. Now let's look at this. So if you say that profit is when your income is bigger than expenses and loss is when your income is less than your expenses, then what if income is actually equal to your expenses? Okay, say you have totally covered all of your expenses. So your income is the same amount of money as your expenses. And so that we have a term for it as well. And we actually call it break even. Okay. Right, so we call that break even. So we also call it the break even point. This is when your income is equal to the expenses. Okay, right. So this is the equations that we use, okay, to calculate the profit or your loss. Okay, so you use this formula: income subtract expenses, or selling price minus costs. Okay, and so if you calculate this, so this will be on a business level. Okay, this is on you use this on a business level. You can use this on a personal level. So if whatever answer you get is positive, then that means you have made a profit. Okay, but if you use this formula and you get a negative answer, then that's a problem because you've made a loss. Okay, but if you actually get zero, then that is the break even point. Okay, right. So it's very important, guys, that you master all of these concepts, master all of these formulas here. Okay, remember all of these formulas. Right, so this is the formulas that we used again, guys. We have already covered this. The total income would be the fixed income plus the variable cost times n. Okay, and then the total expenses would be the fixed cost plus the variable cost times n. Right. Okay. Now let's look at the business performance now. Each and every month or each and every year, a business has to review its progress, okay, its performance. How has it been performing? Okay, because remember, the goal of each and every business is to make profit and to even make more profit. Okay, so we look at indicators such as the profit margin and the percentage profit. So the profit margin, really, this is a comparison between the profit that you have made and the income that you have received. Okay, let's say in a particular month, let's say in January, let's say just for say, so you say you made 100 rands profit with an income you received of let's say 10,000, let's say 1,000 actually. Okay, and then in Feb you made a profit of, let's say, 300. Okay, and the income that you actually received is 3,000. Okay, now if I were to deduce from these, I would be very happy that in Feb we actually did much better in January because the profit is much bigger. Okay, but if I were to use the profit margin formula, okay, I would actually realize that this is the same performance. Okay, because I would say 100. Okay, we take the profit or divided by income, 100 divided by 1,000. Okay, and then multiply by 100. Okay, so the profit margin for January, so that it will be, okay, 0, 0.1 multiply by 100, that will be 10%. And then for Feb, I do the same thing. So it will be 300, that is my profit, divide that by 3,000, multiply by 100. Okay, do the same thing, that is going to be 0, 0.3 times 100, that is going to be 30%. It's going to be this is actually going to be 10% as well. I mean, okay, it's going to be 10%. So as you can see now, guys, this is the same performance. Okay, it's just that in Feb we saw that, okay, we had a bigger profit. Okay, but compared to the income, okay, it's not the same. So it really depends on these two factors. Okay, so yeah, we look at profit margin. So the higher the profit margin, so the higher the answer, then the higher the profit you have made. Okay, so we look at this to analyze the progress, analyze our performance. Okay, right. So the higher this percentage or this answer is, then the happier we are as a business. And then when it comes to percentage profit is really a comparison between the profit and the expenses of a business. Okay, it's the same thing. And so that means that, so the higher the value in this case, and then that means the higher the profit. Okay, so if this value is lower, then that means that you guys have to actually reduce the expenses, the amount of expenses um, that you have. Okay, right. Now, let's take a look at some of the activities that we have, okay, so that we can consolidate all of this. Okay, I have two activities. Took these from past papers. Okay, and we will try to ensure that we cover each and every question. Before we get into the calculations and activities, let's first discuss the difference between budget and income and expenditure statement. Okay, so these are two documents or two lists of income and expenses, but it's very important that you are able to differentiate between them. Okay, so when it comes to budget, it's really a list of expected income and expenses. Okay, could be for that particular month or a particular year. Now, when we say expected, we mean that you actually throw up a budget before the income and expenses are recorded, okay, or before you incur these expenses, before you receive that income, okay. So this is written or thrown before, okay, the actual income and expenses, okay. Okay, so you would find out that, for an example, schools would have a budget for a particular year. Okay, so they will draw up a budget based on maybe previous experiences, previous incomes, previous expenses. Okay, and so when it comes to the income and expenditure statement, now this is the list of the actual income and expenses. Okay, so this means that this records the income and expenses that actually occurred. So, what we are saying is that the budget is recorded before the actual income and expenses occur. And then the income and expenditure statement is recorded after. Okay. So, you can expect a particular income. Let's say you are a landlord and you expect income, okay, from rent. But it occurs that sometimes tenants do not pay the rent, okay? And so you would put in that rent in your budget, okay? But at the end of the month, the tenant does not have or cannot pay the rent. And so now this would be recorded in the income expenditure statement, okay, that you actually did not receive. So you wouldn't count it as income. So it's very critical that you understand the difference between expected and actual. And that really differentiates between these two. Okay, so it's as simple as that, guys. Okay, so let's move on to these activities then. Right, so start with this activity and we'll do the next one. So this says Bobby lives in India and wants to start his own takeaway business. His specialty is chicken biryani. All his ingredients will be bought in bulk. Okay, so he will not buy these one by one, but he will buy them as a whole. That's what that means. Bobby intends selling a plate of chicken biryani for 80 rupees. Okay, so 80 rupees. So this is the currency they use in India, rupees. So that's 80 rupees. So he's selling each plate of chicken biryani for 80 rupees. Okay. And then table 4 shows the estimated cost of ingredients used to make 8 plates of chicken biryani. Okay, so this is the estimated cost used to make 8 plates. Okay, so we need to note that. Okay, so this is for 8 plates, not for one plate, but for 8 plates of chicken biryani. Okay, so there we go. We have 1 kilogram of chicken, which costs 200 rupees, 1 kilogram of basmati rice, which costs 120 rupees, masala powder, and other ingredients. So all of these all together, they will make up 8 plates, or they will be able to make 8 plates. Okay, and then each plate of biryani will be packaged in a disposable food container that costs 2.43 rupees each. And then this is the glossary. So biryani is a mixed rice dish made up with spices, rice, and meat. So if you did not know what biryani is, then there is a definition for you. Okay, and that's what it looks like. Okay, all right. So let's head on to the questions then. 4.1.1 says determine in rupees the price of 520 grams of chicken. Okay, so we want to determine the price. What we know is that 1 kilogram of chicken is 200 rupees. Okay, that's all we know. Okay, and so now we want the price of 520 gram of chicken. Okay, so let's head on then to these calculations. So that's 4.1.1. Okay, so now it's very important that you realize that this is a question of ratios. Okay, so ratios, guys, you should be able to master ratios and you should be able to identify a ratio question. Okay, so this is a relationship between two quantities. Okay, it's the product and cost. Okay, so saying that what we know is that 1 kilogram of chicken, okay, is 200 rupees. Okay, so that's the relationship there, right? Now we want 520 grams of chicken. Okay, and I need you to note that this 520 grams of chicken, I'm writing it on the left hand side of these columns. Okay, so it's on the left hand side. So kilograms, in this case, chicken should be on the left hand side, and then the costs should be on the right hand side. Okay, so first things first, you have to ensure that the SI units are the same. Okay, so this, what we know or that we are given is written in kilograms, but we have grams. So we have to first convert these grams into kilograms. Okay, so on the side, okay, so we convert. Right. So we actually perform these calculations pretty much frequently. Okay, so you would say that, okay, 1 kilogram is actually equal to 1,000 grams. So there's 1,000 grams in 1 kilogram. Now we want to convert this 520 grams, and it should be on the right hand side. So we write it on the right hand side, grams, and we want to convert it to kilograms. So kilograms on the left hand side. And so I'm just going to write X there. Okay, so this is what we are looking for. We want to convert this. And I think, guys, you should perform conversions this way, because when you do so, then you familiarize yourself with ratio calculations. Okay, so it makes things easier. Okay, this is practice. Okay, so now what we are going to do is that we are going to cross multiply. It's called cross multiplying this 520 with that one. Okay, so that with that, and this with that. Okay, so in this case, that means X, we are going to multiply it with 1,000. Okay, now what do you get when you multiply X with 1,000? Well, you get 1,000x. Okay, 1,000x. So 1,000x is equal to 520. So 520 times 1, that should be 520, right? And then because we want x is in a relationship with 1,000, okay, and is in a multiplication relationship. And so the only way you can get rid of that 1,000, because you want x, is that you should just divide by 1,000. Okay, so divide by it if you want to remove it. So divide that by 1,000 as well. Okay, what we do on the left hand side should also do on the right hand side. Okay, and then 1,000 divided by 1,000, that's 1. So 1x, and so x is actually equal to 520 divided by 1,000. And 520 divided by 1,000 should be 0.52, right? Yes, 0.52 what? Kilograms. Yes, kilograms, right? Remember, x is on the kilogram side, so if you forget the SI unit, you can just take that from there. Okay, so now that we have converted the 520 gram, just going to replace that with 500 0.52 So that will be 0.52 kilograms, right? Okay. So now what we are looking for the cost of 0.52 kilograms of chicken. So this will be X here. Okay. So we do the same thing. Multiply X with 1. So that is 1X or just X. Okay. And that should be equal to 0.52 multiply this with 200. Okay. So 0.52 multiplied by 200. So this is what I'm going to write down. So 0.52 multiplied by 200. And that should give us 104. Okay, so it should be 104. So we write down that answer. So it should be 104 rupees. Okay, so it's very important that you write down, guys, because they even specify that in rupees. So it's 104 rupees. So that's the cost of a 520 gram chicken. Okay, so we move on to 4.1.2. 4.1.2 says calculate the total cost expense, same thing. Okay, so total expense or cost to make and package a plate of chicken biryani. Okay, so to make and package. Okay, so you need to pay attention to questions, guys, to words. Okay, so we're saying that we want the total cost to make, first of all, and to package. Remember, to package, the packaging has its own cost. Okay, remember we said that a single food container is actually 2.43 rupees. Okay, so that means we should add that to the calculations as well. And this is only one plate of chicken biryani. These are ingredients to make 8 plates, right? So what we do is that we can add all of these. Okay, and when we've added all of them and then we divide them by 8, divide the answer by 8, that means we are minimizing that to 1 plate of chicken biryani. Okay, so from 8 plates of chicken biryani to 1 plate of chicken biryani. Okay, and then after we do that, that would be the total cost to make a plate of chicken biryani. After we do that, we add the cost to package a plate of chicken biryani. Okay, right, so let's do that. So let's add. So for 4.1.2, I'm running out of space here. Let's just do this. Okay, there we go. So 4.1.2, the total cost to make. Okay, so I'll just write down cost to make. Okay, so we are adding those. So it's 200 plus 120 plus 10 plus 62. Okay, and the answer, let's add that, 100 plus 120 plus 10 plus 62. That is 392 rupees, right? Now, mind you, this is a cost to make 8 plates. Okay. Okay, but we want a cost to make 1 plate. Okay, so a cost to make 1 plate, we just divide that 392 rupees, divide that by 8. So take our answer and divide it by 8, and that is 49. So 49 rupees to the cost to make 1 plate. Now After we've done that, let's now add the package cost. Okay, remember you are going to package it as well. So going to add that add 2.43 rupees to that 49. Okay, now that means that the total cost is 49 plus 2.43. Okay, so 49 plus 2.43, that is 51.43. Okay, that is 51.43 watt rupees, right? So have to ensure that you write down the units, guys. Okay, so it's 51.43 rupees to make one plate and package it. Okay, right. And then 4.1.3 says Bobby claims that he can make more than 50% profit on one plate of chicken biryani. Verify by showing all calculations if his claim is valid. Okay, so profit. Okay, so the word profit, we know that we have to um, subtract the cost from the income that he gets. So this is basically a question of profit margin. Okay, so this is profit margin. So as we know that profit margin, so this is 4.1.3. So first of all, we know that profit margin is equal to profit divided by income multiplied by 100, right? So the first thing that we have to do, we have to calculate these two. So let's start with profit. So the profit, as we know, is income, okay, minus expenses, okay, or minus cost, right? So this is for one plate, right? So what do we know about income? Will we given anything on income? Yes, there we go. So Bobby intends selling a plate of chicken biryani for 80 rupees. So that is the income that he will receive for one plate of chicken biryani. So going to write 80, that's 8. So his income is 80. And then we subtract the cost. The cost to make one plate, as we had calculated in the previous question, is 51.43. Okay, so that is the profit. So that is the cost, I mean. And now the profit will be, so take our calculators. So that's 80 minus 51.43. And our answer is 28.57. So profit is 28.57 rupees. That's the profit that he will make on one plate. And now let's calculate the profit margin. So that means that our final answer there will be profit, which is 28.57, and then we divide that by the income, which is that 80, and then we simply multiply that by 100. Okay, express that in percentage, as a percentage. So divide by 80 and then multiply that by 100, right? I prefer that you first calculate this. Okay, so 28.57 divided by 80, you get your answer, whatever answer you get, and then you multiply by 100. Okay, so the answer is 35.71. Okay, rounding out to 2 decimal places. What percent? So now, what does this mean about his claim or his statement? So because he says that he can make more than 50% on one plate. Okay, and as we see, this is actually less than 50%. So that means that his claim is incorrect. Because this answer is less than. Okay. So as you can see, the percentage, um, the profit margin is actually less than 50%. Okay. There we go. Right. So that's it for this question. Okay. Right. Let's move on to the next one, guys. The next one. Okay. Okay. So we have Mr. Ngwane designs and makes bedroom and bathroom mirrors. So he makes bedroom and bathroom mirrors to supplement his income. So by supplementing his income, that means that he already has a source of income. So maybe he's working where he's getting a fixed income. Okay. So you have to think about these. That means he already has a fixed income. So he has a job. That means he has a fixed income. Right. Okay. So that means that this is a side gig. Right. So he works from home after work. Okay. And on Sundays. Okay. Okay. That's fine. Now, this is table 3. This is SK mirrors, total cost, and total income. Right. Okay. Now, we have the number of mirrors, and this is the total cost. This is the total income. Right. And then he says each mirror is sold. Okay. It's written here. Each mirror is sold for 1,065. Right. So now let's talk about this table here, okay, before we begin with the questions. The number of mirrors, so when the number of mirrors is 0, okay, the total cost is 1,500 rands. Why is that, guys? Okay, so the reason, okay, so this is a fixed expense of 1,500. So let's write that down. So this is a fixed cost or expense. Of course, when he sells one mirror, then the cost will be that, and the total income is that because that's the amount that he will receive. Okay, so on and so on. Okay, okay, that's fine. Okay, now I need us to understand that this income is our variable income. Okay, now it depends. In other words, the income he receives depends on the number of mirrors he sold in that particular month. Okay, so that is the income, and of course, you also have the variable cost. Okay, which depends. As you can see, these numbers keep on changing. It means the cost will depend when he's calculating the total cost for that particular month. He will have, of course, to multiply um, the cost of each mirror by the number of mirrors. Okay, I hope you get me there. Right. So let's just get into the questioning, guys. Okay. 2.4.1 says write down a formula. Write down a formula to determine the total cost of making mirrors. The formula to determine the total cost of making mirrors. Well, remember, guys, we are already equipped with this information. We already know that the total cost, when you are calculating the total cost, you actually add, okay, you add the fixed expense and the variable expense. Okay, so let's write that down. Okay, so the total cost will be the fixed expense plus the variable expense. Okay, or fixed cost and variable cost. The fixed cost, we already identified it, that it is actually 1,500. Okay, it does not depend on the number of mirrors that he actually sells. Okay, and so that's why we say that it is a fixed cost or expense. Now let's talk about the expense to actually make one mirror. So now one would say that, okay, this means that the cost to make 1 mirror is 2,190. Now, the truth is, the total cost, the fixed expense is included into each and one of these values there. So this total cost here, or this value, includes both the cost to make this one mirror and also the fixed cost, okay, which is that 1,500. So that means that we have to first subtract that 1,500 from this 2,190 in order to get to um, the cost to make one mirror. Okay, so that would be our variable expense. Okay, so that means we're going to say 2,190 subtract 1,500. Okay, so I need you guys to note that when we say total cost, we've actually added both of these in each and every one of these. Okay, so that means the cost to make one mirror, we first take that 2,190, so 2,190, okay, and then we subtract 1,500 from it. 1,500. What we are looking for is the cost to make one mirror. Okay, just want to subtract that fixed cost there. Okay, so that we are left with the cost to make one mirror. So that is going to be 2,190, subtract 1,500, and that is going to be 690, right? So 690, that is a cost to make one mirror. Okay, so that means to make two mirrors, you just multiply this by 2, so on and so on. Okay, so now when it comes to this formula, we said that we are going to, a variable cost has an n next to it, so 690 n. This n will enable you to calculate the total cost that you had in that particular month, using, okay, so you substitute in the number of mirrors that you have made in this case in that particular month. So if he made 13 mirrors, then he will substitute 13 here, multiply it by 690, and then add that with the fixed cost, which is 1,500. So this is our formula, guys. Okay, and ensure that you subtract that fixed cost from the total cost here in order to get the variable cost. Okay, right, so let's head on to 2.4.2. 2.4.2 says calculate the missing value b. Okay, so b, here it is, and this is in the same row. Okay, so this is in the total cost row. Okay, and because now we have a formula, it's very easy to calculate it. So we can just substitute 4, right? Because this is the cost to make 4 mirrors, right? So for 2.4.2, okay, let's write here. So 2.4.2, we will take our formula and substitute 4 in the place of n. Okay, so it's going to be 1,500 rands plus 690 times 4. Okay, so first calculate 690 times 4, and then we add 1,500 to the answer. Okay, 690 times 4 is that 2,760, and then we add 1,500 to it. So that's going to be 4,260. So it's 4,260 rands. Okay, so that is the cost to make 4 mirrors. Okay, and it makes sense here, guys. Okay, so you also have to look at that. So that's 4,260, and indeed 4,260 is in between 3,500 and 4,900. So that is B. Okay, that's how we calculate B. Right, let's head on to the next one. So 2.4.3. Now for 2.4.3 says write down the coordinates of the breaking point. Okay, we talked about the breaking point, guys. What did we say the breaking point is? Okay, we said this is when you actually have um, your expenses equaling your income. Okay, so all of your income covers all of your expenses, and you do not make a profit, you do not make a loss. Okay, so this means that we should look for a column where you have the equal, where the total cost is actually equal to the total income. Okay, so as we can see from zero, okay, going this way, we see that the total cost is actually more than the total income. Okay, and at five, you see at five, when he sells more than five, um, when he sells five mirrors, yes, his total income is actually more than, so he makes a profit here, and then from five going all the way. So for number four, so for four, when he sells or makes four mirrors, okay, yes, so these are actually, this is the coordinates of the break even point. So this case, as you can see, when he sells four mirrors, he actually reaches the break even point. So that's the break even point. That's when he will sell four mirrors. So for the coordinates, okay, I think we should also make a video on the graph, right? So the graph, because I some people really find it difficult. So where you have a graph, so in this case, the graph would look something like this. So usually on the x-axis, okay, you actually have the number of the products. Okay, so number of products. So in this case, it's number of mirrors. Okay, and you have, let's say, let's use red for the expense graph or cost graph, and let's use blue for income graph. Right, so the expenses, okay, remember we said that when he sells zero mirrors, the total cost is actually 1,500. So this, of course, would be the amount in rands. Okay, so this is amount in rands. Okay, so from 1,500 to 5,000 to 6,000, so 1,500. So we can use maybe 1,000, 2,000, so on and so on. That's 3,000. That's 4,000. Okay, that's 5. That's 6,000. And that's 7. Right? Now, saying that the total cost or the total expenses when the number of mirrors is 0, okay? So when the number of mirrors is 0, this means over here. So we say that the expense is actually 1,500. So 1,500 is in between like that. Okay. And then for the cost when the mirrors, when you have six, when you are making six mirrors, the cost is 5,600. So 5,600 would be somewhere here. Okay. Right. So this is to make how many mirrors? 6 mirrors, right? So this is for 6 mirrors. And then we join these two lines like that. There we go. So this is our expense graph or line graph. And then our income graph, okay, it starts where? Well, when the numbers of mirrors is 0, the total income is 0. So it starts at 0 actually. So it starts right over there at 0. And then when the number of mirrors sold is 6, then the income is 6.3. Okay, 6,300. So when the number of mirrors is 6, 6,300, 6,300 should somewhere here. Okay. Okay, and then we join these two graphs as well. Okay. So there are regions here you have to understand. First of all, we know that when the number of mirrors is 4, then you have reached the break-even point. The break-even point is marked by the intersection of these two graphs. This is the break-even point, guys. Okay. And so this would only, okay, so according to this table, this would only occur when you have sold 4 mirrors, okay, or made 4 mirrors. Okay, so that is the break-even point. So for this region right over here, that is on the left hand side of the break-even point. So this, as you can see here, guys, the expense graph, okay, is on top or over the income graph. Okay, so as you can see, that means that expenses are more than, so at this region, expenses are actually greater than the income. So that means this region is a loss. Okay, so if he sells maybe less than 4 mirrors, then he's actually going to make a loss. Okay, so if he wants to make a profit, he should sell more than 4. Okay, that means that he should be in this region. Okay, so in this region, as you can see, the income graph is bigger than the expense graph. It's over the expense graph. And so this means that this region is or records a profit. Okay, so if he wants to make profit, he needs to sell more than 4 mirrors, okay, per month. Okay, so now we want coordinates of the break-even point. So the break-even point, the coordinates, okay, so it's how you write the coordinates. So first you start with the x. Okay, so the x in this case is 4, and then the y. Okay, so the y, of course, guys, should be that, yeah, it should be 4 point something, right? So I guess this, I did not, yeah, I did not draw this graph accurately, but yeah, so the answer would be 4,260, right? So this is the answer. Okay, this is what you would write down. Okay, 4,004 is 2, so let's write that down here. So 4 is 2, 4,260. That is how you write the coordinates. And the last question, 2.4.4, says define the term break-even point according to the given context. So according to this context, the break-even point is basically a point where the total income received from selling mirrors and the total cost of making mirrors is the same. Okay, or the point at which the total income and cost of selling mirrors um, is the same. Okay, so let's write that down. So the break-even point in this context is a point where the total income and total cost of making and selling mirrors are the same. Okay, so you have to ensure that, of course, you include the selling of mirrors, because that is the context. Okay, so I just hope, guys, that this video was of benefit to you. I hope this video has made things simpler, much more simpler for you, and I really hope that you will watch more videos that are to come. Please subscribe and please share this channel, guys. We need it to grow.